Spotting breakouts and avoiding fakeouts in the Forex market can be challenging, but with the right strategies and tools, traders can increase their chances of success by analyzing price action, using technical indicators, and understanding market context. Right. Welcome back to CMG Aerospace Trading Channel. We present to you how to spot breakout and fake out exclusively on YouTube and Patreon. Now, this is actually a long time coming topic, and now finally we are here. Let's not waste time here. Let's box in ASAP. So now, here are some key techniques and considerations for identifying genuine breakouts and avoiding fake outs. Right. Now, this video might be in 2 episodes or in 2 sessions. One giving you understanding of what's the concept actually of what breakout and fake out are, and then the second aspect will be a demonstration or presentation of how these things are actually can be seen or be spotted, or yes, in the environment. So if you are here, just stay tuned, relax, and then grab your notepad. Now, what are breakouts? A breakout occurs when the price moves beyond a defined support or resistance level with increased volume. This suggests a potential continuation of the trend in the direction of the breakout. Right, so we are dealing with breakout first, and then we will deal with fake outs. So we are giving a general idea of what it is, and then what to actually look out for, or the factors of that. So how to identify a breakout? 1, support and resistance levels. Now, I think the preliminary course thing here will be an understanding of what resistance levels are. You have idea of what the basics form of what the indicators, right? Indicators, your price levels, your trend lines, and then the volume and all that, right? But I will just talk about them in brief. So 1, support and resistance levels. These also play important role in identifying or spotting what breakouts or fake outs in the environment. Now, so identify key supports and resistance levels on your charts. That is 1, to identify what a breakout. These are the factors. And 2, volume. So look for an increase in volume as the price breaks through the support or resistance level. Higher volume indicates stronger momentum. Now, there's one thing that may sound cliche, yet if you don't take care or you don't actually take time for these things, you would never understand them. You'll be using them here and there, but you never understand them. One is what? Volume or volatility. And then the second thing is what? Liquidity. There's a distinction or a clear distinction between the two. Now, in this video, our attention will be on what? Volume. Right. So let's look at what a volume is, because here in the point 2, we are saying that volume, you should look for what? An increase in volume as the price breaks through the support or resistance level. And we are saying that higher volume indicates stronger momentum. Momentum too is part of the factors that we are going to consider. Momentum, the strong move in that. That's what we're talking about. The rally, whether dipping or going up, right? So in Forex trading, volume refers to the total number of the total amount of a currency. We are talking about amount of a currency traded during what? A specific period of time. It can provide insight into the strength and sustainability of a price movement. However, unlike in stock trading, right, where volume data is more straightforward, volume in FX trading is less transparent and can be challenging to measure accurately because the market is what? Decentralized, right? So here we are saying that even though we talk about volume, liquidity, and here and there, right, In stock trading, we are saying that it's straightforward, right? Then, in fact, everything, many a time, or most of the time, things are clearer, right? So one downside of FX is that sometimes there's lack of transparency, right? If you didn't know, I'm telling you today, sometimes to a degree, there's lack of transparency. You don't see everything. You don't have access to all the data. So that's why more of the work is more of guessing, right? And then looking at what your price action, your charts, and then all that. Many a time you realize that your analysis is right, but you don't know from nowhere the market just changes structure, character, and then things start going outrageously, waywardly, right? So that is one of the things that we are telling you here. And the volume is what? Is the total amount of currency, the total amount of currency, right? The total amount of currency what? Traded within a specific period of time, right? So is the time, that time frame, that's what we are talking about. So within a time frame, right, you can realize that the market is very strong here or weak here. So that is our focus on that. And that will actually help you identify or ascertain or decide if you are to go in here or exit at this level. So that is what we are going to look at. Now, there are two main ways traders can look at volume in FX trading. One, we have the tick volume. Now, the tick volume represents the number of price changes, right? Prices going up and down, up and down, up and down. That's what the ticks we are talking about. It is seen on our chart or basically on TradingView, yes, on whatever tool that you are using. Is that they occur within a given time frame, right? Now, although it doesn't measure the exact number of contracts or lots traded, now, if you don't understand what these things are, you should check in this video description for the beginners class, right? Contracts or lots traded. It provides an approximation of trading activity. Higher tick volume suggests more activity, right? And interest in the particular currency pair. So we are still looking at what? The higher volume. So there may be at times that the market is not actually doing anything, right? It will take time for a candlestick to actually move in the widest range or that. You see, sometimes that happens. The market is just slow, very down. And this is normally seen on Mondays. I see that per my observation, Monday, this is how the market behaves. So market will be moving. Sometimes it will take time to decide which direction to actually move or not. And then on Tuesday, we can see massive rally. From there, Wednesday and Thursday, and then sometimes Friday. And at the end of Friday, after 3 p.m., you see that the market is just capsizing, just not moving, not doing anything. So that is the period that you have to avoid. And then decide, or in fact, spot the higher volume period, and then you trade. So we have time sessions in trading. If you don't know that, still check in the beginners class. So now let's look at broker provided volume, right? So we have checked the tick volume, broker provided volume. Some FX brokers provide their own volume data. Bear in mind, they provide their own volume data based on the trades executed within their platforms. This data can give an indication of market activity, but it is limited to the broker's clientele, and may not represent the entire market. So sometimes if you are observant, if you are not a newbie and are observant, maybe intermediate level or that, if you check on one broker, especially you can check this in TradingView. TradingView, all the pairs are there, but the pairs can be from different brokers. And sometimes their movement can be quite different. Sometimes you see a bullish candlestick on one broker, let's say Pepperstone, and then you see a bearish candlestick on FXM or FCM. You understand? So it happens, right? So they provide their own data. So sometimes the movement, you see a kind of delay here and there. So there's another downside that people also exploit called HFC. If you don't know what is HFC trading, you have to look it up for this. It's very important in your journey. You have to be learning. So sometimes the broker can provide its own volume based on the number of activities or the amount of that currency pair or pairs traded on that broker. So I hope you are assimilating the information right. Now, let's see the importance of volume in trading. One, confirming trends. So increased volume often confirms the strength of a trend, right? Either bullish or bearish, upward, uptrend, or downtrend. For example, if a currency pair is breaking out of a resistance level with high volume, it suggests that the breakout is more likely to be genuine. Don't worry, I'll give you a presentation. I'll give you pictures or some charts for you to for you to help your understanding, right? So identify reversals. How low volume during a price move may indicate a potential reversal, right? So this often happens around maybe the resistance level or the support level. So when price gets to that level and you see that the volumes are not that huge, it's not that strong, it's not that much, then you should be expecting what? A potential reversal. We are saying potential. We are not saying that it's certain, but we are saying a potential what? Reversal. Now, if a currency pair is moving higher, but with decreasing volume, it might suggest that the uptrend is losing its momentum. I'm going to take this in again. I said low volume during a price move may indicate potential reversal. If a currency pair is moving higher, right? A currency pair is moving higher, but with decreasing volume, it might suggest that the upward trend is losing its momentum. Now, let me draw your attention. This can be understood well with the help of some technical indicators, right? Like OBV and then RSI, right? You can help you to do this. They help you in identifying the volume level. You can actually put them onto your charts, right? It's just a matter of going, if you are using TradingView, check indicators and then choose that, and then it will be on what? It will show on your charts. And then from there, you see them. There are some markings, they go up and down. They go like, they are vertical lines at the top. You see, normally here, some are higher, some are this, some are higher, some are this. So that's how they look like. So the length indicates what? The volume level. So that's what we're talking about. Now, let's continue. So now we have it here, right? We have it here. This is how it looks like. If you don't put them on your chart, you will not see them. So that's how they are. If you don't put them on your chart, you won't see them. So this is how they look like. The blues that you see, the blue line that you see at the bottom here. The top here are the price level or the price action, right? This green line is maybe a support or resistance level relative, dependent on the analyst, right? So that is it. Now, let's also look at what the second factor is, what? Candlestick patterns. Now, what for strong candlestick patterns at the what? At the breakout points. Bear in mind, we are looking out for what? How to spot what? Breakouts. So the second thing is what? Candlestick. I think the third thing is candlestick what? Patterns. Now, what for strong candlestick patterns at the breakout points, such as a bullish or bearish engulfing candles, or long-bodied what? Candles. You understand? And then the second thing is also what? This should actually be what? Be on the next paragraph. So chart patterns. Now, chart patterns like triangles, flags, pennants, and head and shoulders can provide breakout signals. So I have actually addressed this candlestick patterns and then the charts in a separate video in the advanced playlist, right? It will give you a snapshot of all the patterns and charts. In fact, it's one of my strategy. I use this for my Confluence. When you trade, after doing your analysis and everything, we use this candlestick charts and patterns to what? We use it as a Confluence to support our bias. So that's what we call it. So you might want to take a break, or maybe afterwards, check in this video description for candlestick charts and patterns. That's the title of the video in the advanced playlist. Right. So Look for clear and well-defined patterns with strong support and resistance level. So whatever we are doing so far, we are saying so far, we are all talking about support and resistance, giving you a help or a confluence. You can't do this without these things. So in forex trading, we work with confluence, confirmations. You build up on whatever you know. So your trend lines, your support and resistance levels, your indicators, your volume, those are the things that we are looking at. Now, let's look at what? The next thing called trend lines. Now, trend line, drawing trend lines on charts can help identify potential breakout points. A break above a descending trend line or below an ascending trend line can signal a breakout, right? So whether maybe let's say a consolidation happened, within these levels. So if they break out, that's what you're talking about, or better below it. So we are talking in relation to the support and trend line. So you should check them. So when they get to that level, what happens? We should look at what? The volume, right? The time frame, the candlestick pattern, or the charts forming. We should look at that as what? Factors. These are the things that you have to consider. You don't just jump into any trade because you see within a time frame or one candlestick moving above and then it's strong. No, there are a number of factors that you have to consider. Else you would experience a fake out and you'd be what? Disappointed. So that's what we are talking about here. Now let's look at confirmation. Now wait for confirmation, a confirmation candle that closes beyond the support or resistance level to avoid false signals. So make sure the candle forming there, very vivid, right? Very vivid, not a weak one, a small candlestick forming, and then you see. So now the fourth one is what? Technical indicators. Now, technical indicators can provide additional confirmation for breakouts and fakeouts. Some commonly used indicators include, let's look here, moving averages, right? In fact, if you have been on this channel, CMG or space, for let's say some months now, you would understand that the only technical indicator I use is moving average. Even in fact, within the even with the moving average, we have a number of examples, types. We have about 4 or 5 of them. But even with that, I mostly use the simple one. We have the exponential also. We have the EMA, and then we have SMA as a type of what? Moving average. So, in fact, at least you should have one technical indicator on your chart. I can also say that it's not by force. Some people, some traders are purely price action traders. They don't really need any technical indicators, right? But in trading, we build up on knowledge, right? We build up on knowledge. If you are young, you are newbie, just do the basics. Then with time, you add up. Now, before one advice from me to you is that before you actually use a technical indicator or put it onto your chart, please make sure you understand the psychology, everything about that technical indicator. So that is why you have to do something called back testing and forward testing. I've also treated that in advanced playlist, right? The advanced playlist, we have 2 types. So look in the second advanced playlist. You will find this thing there, right? Back testing and forward testing to have a full understanding, a complete understanding of that before you put any technical indicator onto your charts. Else, do price action purely and it will actually work. In fact, it works. So that is it. So now back to moving averages. With a simple moving average or the exponential moving average, it can help you. It can help identify trends. A breakout above a significant moving average might confirm an uptrend or better say a downtrend. So in my case, I use SMA, and I use EMA, right? I have 2 trading accounts, trading view accounts. One for analysis, a presentation, teaching, and then one for myself that I can actually do some markets, any markets that I like on it. right, for confirmation, and I transfer onto the one that I teach. So I try to keep the one that I use in teaching or presentation. I keep it clean, right? So you can actually use this, but I love the simple one. Above it, I'm buying. Below it, I'm selling. But I don't jump into it. I wait for other factors of what confluence. So that is what to bear in mind. Now, relative strength index. Now, RSI, right, measures the speed and change of price movements. And an RSI an RSI above 70 can indicate an overbought condition, while that below 30 indicates an oversold condition. Breakouts with RSI moving above 50 can be more convincing, right? So I think I used to use this one. It's also simple, right? You put it on your chart. It's normally at the bottom of the chart, the screen, right? It's like a channel, right? A channel with limits up and below. So moving up, we are heading to the hundreds, and then below it, we are moving to the zero. So it's normally situated between 30 and 70. When it moves below 70, then the what? The price of that currency or instrument has been oversold. For that matter, we are expecting a reversal. So we start to what? You buy. And then when it's at the top, we have is what is perceived to be what? Overbought. And for that matter, we expect the market to what? To start selling. So we are waiting to sell. You understand? So that is the idea of RSI. It's very easy, right? And we have MACD, right? MACD, they are all about markets on the what? On your chart. So MACD helps identify changes in the strength, direction, momentum, and duration of a trend. A crossover of MACD line over the signal line can confirm a breakout. Then we are going to look at Bollinger Bands. Some, in fact, many people use this. It's also simple compared to what? The moving average, right? But this time it comes in 2 or 3. Moving average can be 1. You can have it once on your chart. But the band, Bollinger Band, you see the name is bands. So 2 or more lines, and then the price within them, moving within them. If you moved above, it signals, it moved below, then it signals for what? A sell. So that is it. So that is the chart here. So when price breaks through the upper or lower band, it can signal a breakout, right? So we are looking at a breakout. If you move above it, sorry, then we are going to what? If you move below, but when it's within, you can decide to wait. If you are not already in any trade, that is the idea of what? Bollinger Bands. You can look it up for more information. Now, let's look at Fakeouts. So we have seen the factors to consider in what? Breakouts, right? The volume, the levels, the indicators, and then I think there are other confirmations. So that is it. Now let's look at Fakeout. A Fakeout or false breakout occurs when the price moves beyond a support, right? A price moves. Let's see, this is my resistance and this is my support. When price moves beyond the support, that is what it means. Or resistance here, level, but quickly reverses and trapping traders who entered on the breakout. So you understand? So many a time when people see this, they don't wait for any factors of confluence, right? They don't look for anything. They don't consider whatever the type of candlestick forming around this place or that. And then they jump into it thinking it's a breakout. But then lo and behold, you see that the market starts what? Reverse back and then even come this way. Some can come to this level, right? And go back. We call it retesting. And some can even get here and will even consolidate for a long period, leaving you confused. So that's what we are talking about here to the same thing. I think as if it's going, then all of a sudden the market move this way. So this can be due to some factors like lack of volume, and then inactivity in the market, slow activity in the market. So basically, this is what we call fake out. Now, how to identify a fake out? Volume. We are going to consider these factors again in different what? Idea, understanding. volume. A breakout with low volume is more likely to be a fake out, right? A breakout with low volume, a breakout with low volume is more likely to be a fake out. Wicks, long wicks beyond the supports, right? We are talking about wicks, right? This. So at the tip of it, we call it what? The wicks. So we are saying that long wicks beyond the support or resistance level can indicate rejection and potential breakouts, fakeouts, sorry, and potential what fakeouts, right? Because many a time when market, let's say this is how the market, and then at this point we see a candle this way, right? Initially, the market moved this way, right? Moving with the body, the whole body. So I'm going to draw this, the whole body. Then all of a sudden we see that market starts reversing. So it means that when it starts reversing, the body now moves down, and then it leaves something like a skeleton, right? This way. I hope my drawing is better. Forgive me. This way. So you see, market move this way, thinking it's bullish, very strong. Then all of a sudden, you see the market reversing within, or in fact, on the same candlestick, right? The same time frame. You see that the market start dipping. So you see this way. So that's what we are talking about. So long wicks beyond the support or resistance level can indicate rejection. So it means that the price or the what? Yeah, the buyers have been what overtaken, right? And then the market has been rejected. And then that will bring about what? Fake outs, right? So that's one of the things that you have to check. Right. Now, confirmation. Now, if the price quickly reverses after breaking the support, reverses, that's what we are talking about. We have explained already. Reverses quickly after breaking the support or resistance level and closes back within the range, right? I've explained, it might be a fake out. Wait for a candle to close above resistance or below support to confirm the breakout. And this is where we lack something called a key factor or trait in traits in Forex called patience. So people see that a trader sees that at the resistance level or support level, and then they jump quickly into it. Whilst they have to wait for maybe a retest, a pullback, or that confirmation, and then they jump into it. They will leave you what? Disappointing. Now, consider using multi-time frame analysis to ensure the breakout is confirmed on higher time frames as well. So this is what we call top-down analysis, right? Top-down analysis is very important. You don't use one time frame to do analysis, right? You have to use about three. The least time frame that you can use is three. So, example, you use the day time frame, the 4 hour, or okay, in my case, let me use my case. I use the weekly time frame, the day, and then the 4 hour. That is my top-down analysis time frame that I use. I use week, day, and then the 4 hour. Sometimes I can go down to the 1 hour if I want to trade the earliest stages of that. So these are the things that you have to do. You can't use one time frame to confirm or to decide that the market is moving this way or that. So if you have realized that on my channel, I provide weekly FX forecasts, and I use top-down analysis, right? And then retesting. After a breakout, the price often retests the broken support or resistance level. Successful retests, that's where the price holds a new support or resistance, can confirm a breakout. Now, avoid overtrading. This is very important. Avoid jumping into trades immediately after a breakout. We have to look at this. Allow time for confirmation and watch for signs of strength or weaknesses weakness in price action, in the price action. News and events can be one factor. You have to consider it's many a time. This is what spoils the structure of a pair or an instrument. You do analysis, hoping the market move this way, or maybe with time. You don't even expect it to move faster or slower. But then a news will come, and then actually mess up the whole structure, the market structure, or that currency structure or character. And then you have to do another what, look for another entry or that. So you have to be very careful about this. Sometimes, even in my case, I advise that after doing analysis, even once you are even trading with full confidence, you have to be watching your fundamentals. If it's getting around this time, you may have to decide if to exit and then look for another entry, or if you're that of a swinger in coach, you can leave it. But it's advisable that you have to check this out. You can be profitable within a week. Then at the end of the week, you lose everything. And the causes, one of them is news or events. So you have to be very careful about this. So now, let's look for stop loss. Let's look, stop loss placement. You have to be keen on this. It's in fact, it's advised even from professionals that you should not place a trade or position without what? SL, else you lose your account. So it's very important you do this. Where to place them is very important. Now, the last thing is what? Divergence. What for divergence between price action and indicators like the RSI or the MACD. For example, if the price makes a new high, but the RSI does not, it could indicate a potential fake out. You can look out for what's a divergence trading. It's a whole topic that I might have to treat, right? It's very important. In fact, some people use it as their main strategy. So it's quite informative. Now, by combining these techniques and maintaining discipline in your trading approach, you can improve your ability to spot genuine breakouts and avoid fakeouts in the FX market. Now, let's look at some diagrams to help you understand whatever we have done so far, right? Some people can learn more well with what? Graphical representation. I actually wanted to show you my chart, my trading view, by analysis that I've done over the years, right? I'll show you the breakouts, where the breakouts are, where the fakeouts are, even my strategy actually. But with the time, I think I can't do that. So maybe I'll have to do a separate video, right, on my strategy actually. So let's do that. From there, I'll show you. So one, I actually picked this from what? Trading Fuel, right? The source. Now, look at this. What is happening here? We are experiencing a downtrend, right? And then when it gets here, we are experiencing a consolidation. This is actually one of my strategy, right? In terms of candlestick trading or patterns. When it comes to this level, I wait for consolidation. And in my case, I would have expected what? A continuation. But in this case, you realize that if I had traded this or I've seen this, I would conceive what? I would have conceived loss. I have to be honest with you. It's my strategy. So I knew that even though I have not traded, I didn't trade this. If I had traded this or I've seen this particular market structure, I would have entered and I would conceive a loss. But bear in mind, lo and behold, I could also avoid this, because in trading, I have to consider the candlestick patterns forming at the resistance and then the support level. You understand what is happening here? So after that, then I will decide. Good. So that is what I'm saying. I have to be honest with you. I would have conceived the loss. The probability would have even be more than 0.9. So that is it. So here, see what is happening here. This is actually a fake out. Right. So if you see this candlesticks here, you see what is happening here. You see that a long one, and then what? A long bearish candle. Then we have a small one, and then before we have the another bearish there at the top. It shouldn't even be a bearish, but no problem, no worry. So that is it. So this is a fake out, because we would have expected that market to continue dipping. But now see what happened. But considering again, looking at the candlestick patterns, you may have avoided it. So that is it. Now let's look at this also. We experience once again a plummeting environment, a dip on that currency, a slanted trend line, experiencing what? A sell. But see what happens here. So when we see here, you see the rejection here. So that's why when you see such a thing, you have to be very careful. The wick there now is because we have read it. So I don't want to assume it's like I have the knowledge. That's why it seems you could have you could have avoided it. But trust me, if if he hadn't known this information, you would have conceived a loss. Because with that week, you would have entered, not waiting for the candlesticks to actually close to see whether this week will be that of what. This is a gravestone or that inverted hammer, right? So that is it. You have to be honest with yourself. So you see what is happening here too. Let me zoom a bit. So you see what is happening here, right here, and then see what is here. It's a what? A bullish candlestick forming there before the red. So you would have entered if you are impatient in the market. See what is happening here with the trend line. In fact, here it actually moved above it, far away, before reversing again. So that is why sometimes it's many a time it's even advised that you should wait for a retest. So at a retest at here, you would have decided if you have to continue entering or not, based on what the candlestick that have to form here. But in fact, if you have waited or you trade with what retesting as a confluence, you wouldn't enter this because the candlestick forming there is not a bullish candlestick pattern forming there. So you understand. So I hope you are getting the picture. Now, so let's continue. This is vivid. It's easy to understand. You see, market is assumed to be what? Coming down. In fact, going up, buying, being bullish, got this point. You have to breathe in by consolidating for a long time and then see what is happening here. Right? So here, you can see that, you see the candlestick for me here, they are all bullish. Right? And then even if you have waited after this one and entered here, it has come back for retest. Yet the candle for me here is very bullish, strong. So we experience a bullish environment before coming down. So if you had traded this, you'll be what? Profitable for a breakout, right? And then later you decide if you have to what, exit and check the candlestick pattern for me. So in fact, even after breakouts and then experiencing or enjoying that level, you have to be mindful, checking the candlestick, monitoring the environment to see if it's going to change movement or character. Then that is it. Then you see fake out here. It's what's selling, go to this point, and then this is what happened. So when you got to this point, it means that this would have been our support. But now that has been rejected and we are going back. Now is now our what? Also coming down, support. And then still it's still our support, right? So we still our support because prices are just are still above it. So still our support. So here you have seen that the candlestick for me here is what? Is bullish. And this is what the Tuesday's bottom. If you know it, I think you understand what I'm talking about. From here and then it went up again, right? So with here, because it's a bullish engulfing, you would have thought now market is going to be what? Rallying, going up massively. But lo and behold, market comes down again. So you see, so that's the problem. So you have to be monitoring, right? So this is a fake out. A fake out because initially you thought this is a bullish trend because looking at the candlestick pattern itself is bullish. But see what happened. So the problem may be a news or volume causing that problem. So you can't do this in isolation with just your candlestick patterns or charts. You have to be checking the environments, the volume, everything that is happening at that moment. So that is it. And let's go down again. I love this chart also. So you see what is happening here. The top is assumed to be what? Our resistance, down, our support. So we experience a consolidating market, right? Environment here, from here, here, here. And then when you see here, you can see that market looked what? Like it has broken out. Because if you look at the recent candlestick forming there, they are very, very bullish. Right? Very, 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 very bullish. A minute. right? Very, very bullish. But then lo and behold, see what happened again. Market started dipping. So you have to be very careful. Very, very careful. So in my case, normally, I would be, if you have known or you have been on this channel for a long time, you realize that I don't really fancy horizontal consolidations, right? Bear in mind, we can have consolidating markets in a what? In a trendy one. Let me give you an example. We can have environment moving this way, even though generally it's bullish, it's still what? Consolidating. So consolidation is not always the traditional way. We have either descending or ascending consolidation. So in my case, I normally do not like trading what? Within consolidation, the horizontal ones. So when it happens this way, what I look for, my next move is to look for what? A breakout. That is what I do. My strategy, I think I'm even telling you some aspect of my strategy. So I just look for a breakout on it whilst watching the market closely, checking the candlestick pattern for me, and then the volume, and then the time of what? The session. You see, you have to check this. Very, very important. So you see what is happening. And then here, so here was a fake out because it didn't continue, market didn't continue going up. It fake out by what? By reversing. And then when it got here is actually what? A breakout. Because the candlestick pattern forming here, very, very strong. Bearish candlestick pattern forming, very, very strong. So that is it. And here too, the fake out, even the onset was a fake out. Because look at this, the red candlestick forming is bearish. So one would have thought that there's a breakout, right? There's a breakout before this, the green forming. But lo and behold, after the red, the green form, and this is called Tuesday's bottom. A Tuesday's bottom is an indication of a bullish market or bullish trend. If you don't know your patterns, I know you have to know them offhand. So you can realize that I'm just mentioning them. And this actually helps as a confluence. If you know one thing, you add one thing to it, you become like a boss. So that is it. And then the last but not the least, in fact, this should be my what? My use case for this presentation, right? So let's assume that you are here, you are experiencing what? A consolidating what? Market. Let me draw this line for you, right? Market goes up, comes down, goes up, comes down. This is our support. Comes down. So when it gets here, then you see this breakout, right? But when it broke out, it got to this level. Bear in mind, when you are watching the market, you have to look for something called supply zone and demand zone. They're very, very important. They can cause changes, a huge or massive changes in the environment. At that point, market can move strongly. So within here, I told you even in trading, right? When you go to a higher time frame, the market can look can give you another perspective. When it comes to the lower time frame, the market can also give you another perspective. So what you have to look out for is when you are studying the higher time frame, you have to, after studying that, come to the lower time frame and then see what is happening within. So in my case, I have devised a word called a nested environment or market structure or cascading structure, right? This term is an IT term, but it's actually helping me here, right? You realize that whatever is happening at the higher time frame, there's another thing happening within. So sometimes you can even trade a consolidating environment within another consolidating environment, right? You can even trade within an a rallying market, let's say an uptrend. You can be trading within, looking at the higher time frame. So this is what brings about the difference between a scalper and then maybe a position trader or a swing trader or a day trader. So you see the differences. So they go hand in hand. You have to be checking distance. Don't worry, this may seem like too much, but with time and with practice, with screen time, you will be perfect at these things, right? So that will bring us to the end of this chat. I hope you really understood this. Else, you can even message me comments here. Maybe the time and then the rate at which I was talking may be too fast, right? You can ask for audience, and this is free. One video, and I will explain everything to you with this. If you want this particular presentation, the PDF, I can also send it to you after contacting me, right? So besides this market insider you provide on this channel, we provide mining gigs, as in crypto mining gigs, giving you opportunities, let you know the famous airdrops you can join. And then market insight, we also provide weekly FX forecast. Give you at the beginning of the week, that's Sunday evening, give you a general perspective of how the market has the potential of moving. And then within the course of the week, we give you live updates in our Telegram channel, telling you if the initial setup or analysis is valid or not. So just check in this video description for important links, other things, explore this channel, and then you'll be good to go. We will say bye for now. See you in the next video. Bye.